data released today shows that Chinese factory activity has shrunk for a fifth straight month, while new export orders have hit a 4-month low. Hiring in that country has slumped to a 2-year low, and domestic demand also seems to be taking a hit in the world's second largest economy. The data came in much worse than was expected, and this has now prompted talks of a likely central bank intervention to boost growth. Arnold Gay at Reuters files this report on the road ahead for China.
Factory activity in China slowed for a fifth straight month in March, with the contraction deepening and new orders tumbling to a 4-month low. HSBC's Flash Purchasing Managers Index fell to 48.1, weakening from last month's 49.6 and dropping further below the 50 level that demarcates expansion from contraction. More worryingly, input prices, the cost of raw materials, was the only component that stayed constant, pointing to continuing inflation risks. The employment component weakened, suggesting lower manufacturing activity was starting to affect hiring. Copper prices and the Australian and New Zealand currencies fell Thursday, and many Asian stock markets weakened before paring losses. The PMI data reinforces more bearish views on China's economic trajectory, but Bergvis does not see stimulus measures ahead. China's central bank has relaxed bank reserve ratios twice since November, but has refrained from cutting interest rates. Arnold Gay, Reuters.
All right, then, for more on China, let's go across to Hong Kong, where Robert Bergquist, chief economist at SEB, joins us with his views on the Chinese story. Now, Robert, China's PMI results are out. The numbers are looking rather dismal. Your reaction?
Well, of course, China has become very important for the global economy, and that we now see this kind of slowdown. I think it's to some extent, I think it reflects previous austerity measures, but also the slowdown that we saw in Europe and also in the US last half year. So we shouldn't be surprised that we see this kind of slowdown in the PMI for Asia. But it's quite important that we are not going to see too much of a drop in the PMIs, because that could be a negative factor for the stock market, of course, and then it could have a kind of spillover effect on consumer confidence, business confidence, and then it could be a kind of drag on the global economy and, of course, also on the Asian economy.
Now, Robert, what do you believe China's central bank might do now, given the risk of oil prices? Does it stem the pace of its monetary policy easing?
Well, I think that the policy that you should implement in China, that is of course dependent on this slowdown that we see. If you think it's temporary, then of course it's a task for the central bank to provide more expansive monetary conditions. If you believe that the slowdown is going to be more sustainable, then we should expect more of kind of fiscal measures, stimulus from the government. But I think that what we see right now, that is a kind of short-term slowdown in the Chinese economy. So it's the responsibility for the Chinese central bank to provide more support. And so we should expect more support, lower cash requirements from the central bank, and maybe also rate cuts from the central bank going forward.
Now, Robert, taken together, the Chinese slowdown, the US upturn, and the ECB liquidity injection, what's the probability of a global recession now?
Most of the indicators are confirming a more solid recovery of the US economy. So that is, of course, very good. What the European Central Bank has done, providing huge amount of liquidity, that is also very good, because at the end of last year, I would say that we were quite close to some kind of very serious credit contraction. And with the ECB money, we have avoided that kind of situation. So I think it looks more promising. But what makes me a bit concerned today, that is, of course, what's happening with the oil price. We shouldn't underestimate the impact from the oil price. We have, of course, an impact on inflation, but I think that is not the key issue. I'm more concerned about that manufacturers could be more concerned about the supply of energy going forward, and also the price of supply. So the oil price, that is one risk factor. The other risk factor, that is, of course, rising interest rates. Because the world economy, the household sector in many countries, the government sector, we are still very dependent on a low interest rate environment.